My wealth has come from a combination of living in America, some lucky genes, and compound interest. That's Warren Buffett, one of the greatest investors who ever lived. And the strategy that puts that force to work better than almost any other is dividend investing. If you're a beginner looking for a step-by-step guide from knowledge to real-life examples, you've come to the right place. In this video, I'll walk you through the whole thing, what a dividend actually is, how one simple move turns small money into a snowball, how to pick stocks that keep paying, and how to build a portfolio. You can start with almost nothing. You'll meet John. He starts from zero savings, investing just $10 a day. And by the end, I'll show you how John's $10 a day habit in a portfolio we'll build together in this video is projected to reach a $1.5 million valuation and pay him around $6,500 a month. So let's start with the basics. What actually is a dividend? Here's the simplest way to think about it. When you buy a stock, you own a tiny piece of a company. And some companies share their profits with the people who own them. That share is the dividend. That's it. You own a slice, the company makes money, and it pays you part of it just for holding on. Let me show you with a simple example. Say a stock costs $10 a share. You buy 100 shares, so you've put in $1,000. Now, say the company pays 50 cents per share in dividends every year. You own 100 shares, so you get $50 that year. $50 on 1,000 invested. That's a 5% dividend yield. And here's the part that makes dividends different. You didn't sell anything. You still own all 100 shares. The $50 just showed up for doing nothing but holding. That's the whole appeal. Most investing only pays you when you sell. Dividends pay you while you wait. Now look, $50 a year isn't changing anyone's life. Nobody's retiring on that, but it's a seed. And what you do with that seed, well, that's where this gets good. But here's the catch. Not every company that pays a dividend keeps paying it. Some cut it, some stop completely. So before you ever buy one, you've got to check a few things. And checking those things used to be the hard part. Everything I'm about to teach you gets a lot easier with one tool, so let me put it on your radar right now. The tool is Investing Pro from investing.com, the world's leading financial information website. I'm currently an Investing Pro member. It's their flagship product, and it has a strong set of features for analyzing stocks and ETFs. I used the screener to cut my stock research from days to under an hour. That's how this video got made. The big worry with any dividend stock is always the same. Is the company going to keep paying or cut the dividend and leave you stuck? That's really the whole thing. And finding out used to mean bouncing around 5 different websites for over an hour. Investing Pro makes this simple. You just search the stock and everything that matters is right there. There's a health score, green or red, that tells you right away if a company can actually afford its dividend. It tells you if the stock's overpriced or a good deal. And it shows you years of dividend history so you can spot whether they've actually kept paying even when times got tough. There's loads more in there too. ProPicks AI for stock ideas, even Warren AI. You can ask any question about a stock and it answers. I'll show you the stocks I picked using Investing Pro in a couple of minutes, but right now, investing.com is running a flash sale with 55% off Investing Pro, the lowest price. But this is the exciting part. I have an even better offer. Use the first link in the description or in the pinned comments, or add my code at checkout, John's Money Adventures, all one word. You'll get an extra 15% off on top of the current flash sale. Don't miss out. It's the first link in the description of this video. Go grab it. Now, a tool like Investing Pro only helps if you know what you're looking for. And this is exactly where most people go wrong. They pick stocks before they've worked out what they actually want from those stocks. And that's backwards. The right stock for one person is the wrong stock for another. It all depends on what you're trying to do. So let's figure out John's goal first, just like you should figure out yours. There are really two things you're choosing between: income now or growth over time. Income now means you want the cash showing up soon. Maybe you're close to retirement. Maybe you just want the money working today. If that's you, you'd lean towards stocks paying bigger dividends right away. Growth over time is the other path. You don't need the money yet. You're fine waiting, letting it build because you know it'll all be worth a lot more later. If that's where you're at, you'd pick stocks that grow steadily for years. John is in his early 30s. He doesn't need the income today. He's got time and he'd rather have a lot more later than a little now. So John picks growth. Then there's one more thing to be honest with yourself about. How much risk are you actually willing to handle? And I don't mean on paper. I mean, if your stocks dropped 20% next month, would you be a person who panics and sells? Or could you actually sit tight and wait it out? Because that answer changes everything. If big swings keep you up at night, you want steady, boring, established companies. If you can stomach more movement for a bigger payoff, you've got more room to play with. And there's no right answer here. There's only your answer, what you're comfortable with. John knows himself. He's not chasing the wildest thing on the market. He wants growth, but the kind he can sleep through. Steady companies that have paid for decades. So now John has his two answers: growth over income, steady over wild. John now knows where he's going. The how is where it gets interesting, and there are two ways to play it: the fast way and the slow way. The fast way is what most people picture when they think about investing. You put in a big chunk of money, you pick stocks you think will jump, and you try to grow it quickly. And it can work, but there's a cost. To make real money fast, you need real money to start. Say you've got $1,000 in a stock that climbs 10% a year. That's a good year, and it's $100. $100 on $1,000 invested after a full year. So if you want to make, say, $10,000 a year that way, you're not starting with $1,000. You need to start with $100,000. And most people don't have that sitting around. That's the catch. With fast, it rewards people who are already rich. The slow way flips it. You don't need a pile of money up front. You need a little, but you do need time. John is starting with zero initial investment. He's willing to invest $10 a day, about what a lunch costs. That's it. Now, $10 doesn't sound like much, and on day one it isn't. But John's not betting on one good year. He's stacking small amounts over and over till he retires. And buying a little every day does something clever. Some days the stock is up, so his $10 buys less. Some days it's down, so the same $10 can buy more. Over time, that evens out. He ends up with a steady average price without ever having to time the market, which, by the way, almost nobody can do anyway. This all has a name. It's called dollar cost averaging, and it's the advantage of the slow, steady approach. And that is the road John has decided to take. $10 a day, the slow way, buying through every up and every down. Now, in a couple of minutes, I'll show you how to narrow down stocks for your portfolio. And in the end, I'll show you a portfolio that, with John's $10 a day, is projected to reach over $1.5 million and pay him over $6,500 a month in dividend income. But first, to make this work, you need one simple move that turns that daily $10 into a snowball. The move is this. When a stock pays you a dividend, don't pocket the cash. Use that money to buy more of the stock. That's it. That's the whole thing. It's so simple, but it's the single biggest reason small money turns into big money. Let me show you why with simple numbers. Say you buy 20 shares of a stock at $5 each. That's $100 in. And say it pays a 5% dividend. End of year one, that dividend pays you $5. Now, you could take that $5 and walk away, or you could buy another share with it. So you do. Now you own 21 shares instead of 20. Here's where it gets good. Watch what happens the next year. Those 21 shares obviously pay you more than the 20 did. It's not $5 now, it's $5.25. So you buy more shares again, and now you've got 22. By year 3, that dividend is up to $5.51, and your share count keeps climbing. More shares pay more dividends, buy more shares, and around we go. And notice the stock price never moved. It's still $5. All that growth came from one thing: reinvesting. That is compounding, the snowball. And I know what you're thinking. Over 3 years, it's barely noticeable, a few extra dollars. You'd be forgiven for thinking it's not worth it, but this snowball doesn't run for just 3 years. John lets the snowball roll downhill for 30 years. 3 years is a few extra shares. 30 years is the difference between a little money and the number I promised you at the start of this video. So that is John's plan locked in. $10 a day, steady buying, every dividend reinvested. Time does the rest. That's the plan. Now, what do we put John's money into? Here's the mistake most beginners make. They go out and buy a random handful of stocks they've heard about. No structure, just names. But a good portfolio isn't a pile of stocks. It's built in 2 layers, a foundation and then satellites around it. Let's start with the foundation. This is the base of everything, the part you want rock solid and boring. Not exciting, boring on purpose. And the best foundation for a beginner isn't a single stock at all. It's a dividend ETF. Quick reminder, an ETF is just a basket. Instead of one company, you're buying a slice of dozens or even hundreds all at once. So if one company in there has a bad year, it barely moves your basket. That's instant safety in one buy. So the foundation is a solid dividend ETF. That's the anchor, the thing that holds steady while everything else does its job. Then come the satellites. These are individual stocks you add around the foundation to give your portfolio more growth and more income than the ETF alone. But you can't just pick any stock here. Satellites need to be strong on their own. So how do you find ones that are? Well, you look for a track record. The gold standard is a group called the Dividend Aristocrats, companies that have raised their dividend every single year for at least 25 years straight. Not just paid those dividends, but raised them through recessions, crashes, all of it. Think about what that takes. To pull that off, a company has to keep making more money decade after decade. Weak companies can't fake it. But here's the part most people get wrong. They treat that 25-year list like it's the only safe option. It isn't. A younger company, one that's raised its dividend for, say, 15 years, can still be a fantastic satellite. The 25-year badge is a shortcut, but it's not a hard rule. Some of the best dividend stocks just haven't been at it long enough to earn that badge yet. So how do you tell? If a company doesn't have that long of a track record, how do you know it's still strong enough to trust? You look at 4 numbers, and every one of them is on Investing Pro, so you don't have to calculate anything yourself. Start with the yield. That's how much a stock pays you right now as a percent of what you put in. Now, one more warning, because this is where beginners get burned the most. The trap is a really high yield. Look, you'll see a stock paying 12%, 15%, even higher, and your brain goes, "Whoa, that's incredible, sign me up for that one." Well, stop. Don't take the bait. Because most of the time a yield that high isn't a gift, it's a red flag. Usually it means the stock price has crashed, which makes the yield look huge, and a crashing price often means the company's in trouble and a dividend cut is coming. So a sky-high yield isn't the prize. Like I said, it's the bait, and you are not a fish. Remember this, the safe, boring 2 or 3% from a healthy company beats a 15% that disappears next year. The second number to consider is the payout ratio. This tells you how much of a company's profit is going out the door as dividends. Say a company earns $1 and pays out 50 cents. That is a 50% payout ratio. And here's the rule of thumb. Under 50% is healthy. The company's paying you and keeping plenty to grow its business. Once you get above 70%, that's a warning. They're paying out almost everything they make, which means there's nothing left if a bad year hits. Third, and this is the one that matters most, dividend growth. That's how fast the payment gets bigger year after year. And you've already seen why this one's king. Remember the snowball? A dividend growing fast is what makes that snowball roll faster and faster. A nice yield today is fine, but a fast-growing dividend is what turns small money into real money. And the fourth number is price appreciation. That's how fast the stock price itself climbs over time. Because you're not just collecting dividends here. The shares you already own should also grow over time. So that's the 4-point checklist. 4 numbers, and they tell you almost everything about whether a dividend is built to last. Now let me show you the real stocks I picked and run every one through these exact 4 numbers. 1 foundation, 4 satellites. Let's start with the foundation, SCHD, the Schwab U.S. Dividend Equity ETF. Remember, the foundation isn't one company, it's a basket. One buy, and you own a slice of around 100 dividend companies, spread across tech, healthcare, energy, all of it. That's the safety net this whole thing sits on. And in all 4 numbers, SCHD's rock solid, a 3.18% yield. The dividend has grown about 10.5% a year on average over the last decade. The price, about 8.9% on average each year. Steady, broad, boring. Exactly what a foundation should be. Now the satellites. First of which is Lowe's, the home improvement giant. It's raised its dividend for 42 years in a row. Number 1, the yield, about 2.4%. Number 2, the payout ratio, right around 40%, comfortably under our 50% line. So the dividend is genuinely safe, and there's plenty of room to keep growing it. Number 3, dividend growth. Lowe's has grown its dividend by about 15.5% a year. A payment growing that fast doesn't stay small for long. And number 4, appreciation. The price climbs about 10.3% a year on top of all that. Our second satellite is NextEra, the utility. A 2.9% yield, payout ratio around 59%, not the under 50% ideal number, but well clear of the 70% danger line. Dividend growing about 11% a year, price up about 10.8%. Safe and steady. ADP runs payroll for half the companies you've ever heard of. A 2.9% yield, payout ratio about 59%, dividend up around 12% a year, price about 10.3%. Same solid picture. The fourth satellite, United Health. Our youngest stock, only 16 years of raises, so not a full dividend aristocrat. So because of that, this is the one we investigate the hardest. And it holds up. A 2.3% yield, payout ratio around 67%, the highest of the group, but still under our 70% threshold. The dividend has grown about 16% a year, the fastest of the bunch, with the price up around 11% on average each year. Strong, healthy, growing. It passes. It just hasn't been at it long enough to earn the dividend aristocrat badge yet. That's the whole point of running stocks through the 4 numbers. They let you trust a stock the shortcut alone would have told you to skip. By the way, everything I just did there, the searching, the company profiles, the numbers, all of it was all inside Investing Pro. If you want to run your own picks through it, use my code John's Money Adventures, all one word, at checkout. Or hit the link in the description. You'll get 15% off on top of the 55% flash sale they have right now. Okay, back to the lineup. 1 ETF holding the base, 4 strong companies around it. But there's a mistake you could make right here that wrecks more beginner portfolios than any bad stock pick ever could. Some beginners look at the numbers and find the one stock with the best growth and dump everything into it. All their money, one company. And you can see why. If United Health's dividend is growing 16% a year, why not just buy a pile of that and skip the rest? Well, here's why. Because nobody, not you, not me, not the smartest analyst on Wall Street, actually knows the future. Every one of those growth numbers is based on the past. And the past is a good guide, but it's not a promise. A company that's grown for 16 years straight can still hit a bad decade. The whole industry can stumble. It happens. If you put everything into one stock and it has a rough 10 years, your entire plan backfires. It doesn't work. Not because you picked a bad company, just because you picked only one. That's the trap, putting all your faith in the one that looks best on paper. The fix here is simple. You spread your money out across different companies in different parts of the economy. Look at what this portfolio does. A utility, a healthcare company, a retailer, a payroll company, and the ETF underneath it all holding 100 more. Now, if one of them has a bad decade, the others carry the portfolio. One stumble doesn't sink you. That is diversification. And it's exactly why John doesn't go all in on the fastest grower. He spreads it. Blended together, the portfolio yields about 2.74%, with the dividend growing around 13% a year and the share price climbing about 10.3%. A modest yield, but strong, steady growth. And that growth is the engine that does the real work over 30 years. One thing before we run the projection numbers. These projections assume the money grows untouched in a tax-advantaged account, like a Roth IRA. In a traditional account, taxes take a cut along the way and the final number comes out lower. So if you can, use tax-advantaged accounts to your benefit. When you open an investing account, look for one called a Roth IRA. Most brokerages offer it. It's free and takes about 10 minutes to set up. Okay, now let's run the numbers. $10 a day into the portfolio we just built. Every dividend reinvested. Year one, John puts in about $3,650. That's his $10 a day for the first year. But watch what time would do to it. By year 10, that account wouldn't be $36,000, what he put in. It would grow to around $68,920. The market and the dividends would already be pulling more than their weight. By year 20, it would sit around $335,979. And by year 30, it would reach $1,513,656. $1.5 million from $10 a day. Over 30 years, John would put in $109,500 of his own money. The market would add around $929,000 on top, and the dividends he reinvested, another $475,000. John contributed the smallest slice of all. Time did the rest. But here's the part that actually matters. That pile wouldn't just sit there, it would pay him. By year 30, that portfolio is projected to pay about $78,515 a year in dividends. That's $6,543 a month. Every month for doing nothing but holding. That's more than a lot of people earn at a full-time job. Paid to John for life on a habit that started at $10 a day. That's the whole point of dividend investing. It doesn't need a big number to start. So 30 years is one timeline, 20 is another, 10 is a different beast entirely. I ran the numbers on what it actually takes to hit $1 million on Fidelity Index funds across all three of those timelines. And that video is on screen right now.